So he has to go back to square one. What's square one? Waiting for specific times of the day. So let's look at the London session. Now, as far as indices, I haven't talked too much about indices, but we'll be doing that. And I actually got some live sessions we'll do during the London hours. What's that? I got to call out of work. I can't miss that ICT. There you go. Anticipation. You can't react to it. So London, by characteristic, what I'm referring to is we always refer to things in New York local time. So whatever the time is in New York, you need to have a clock set at your trading desk that is always showing you New York local time. I don't care where you live in the world, everything algorithmically is running on New York time. I don't care who tells you otherwise. I don't care. Okay. It's just the way it is. Just submit to it. So when I talk about specific times of the day, it's always on the basis of New York. Okay. So London time between 2 o'clock in the morning, New York local time, to 5 a.m., New York local time. That's a 3-hour window. And the sweet spot is between 2 o'clock and 4 o'clock. So those 2 hours, but it can extend to 5 a.m. Generally, you're going to get some kind of false breakout. Okay. And that's not earth shattering. There's always been some idea of expectation of anticipating some false breakout in London. That's just the natural characteristic to it. What you need to be concerned about is where we are coming from on the hard time frame weekly and daily chart. If you're trading in London, if you're not referring to the weekly and daily for your setup, you're trading blind. You have to look at what that weekly, what's the importance of the weekly chart, Michael? Well, I talk about how you can anticipate, not react, anticipate where that weekly chart candle that's forming or that will form tomorrow when it starts on Sunday at 6 p.m. when all trading begins. Now we're starting a new weekly candle. So you want to anticipate the likelihood of that weekly candle expanding up or expanding down. And you're looking for an inefficiency or stops that's most likely going to be the draw. It doesn't mean you're going to be right. Sometimes I get it wrong. It's okay. You're going to, especially with the climate right now, we don't know what war is going to break out. We don't know if the bank's going to close over here. We don't know if, the Fed's going to do that. There's so many things that are compounding the difficulty right now. And anybody that tells you it's easy, they're lying to you. They're just championing their getting lucky sessions at the time, and they're probably not showing you all the times that they're losing. But you have to factor in what that weekly chart is doing, likely to do, and that starts your bias, bullish or bearish. And on the daily chart, you have to confer with the previous day's range. Now, let's assume for a moment that the weekly chart, you think that there's going to be an expansion lower on whatever market you're trading. Now, this is both Forex and index futures and commodities. Okay, so it's not, unless I say, here's another general rule of thumb. Unless you hear me say this only works, everything I'm teaching you works on Forex and it works on futures, index futures and commodities. Okay. I don't know about crypto. I don't have any affinity for it. So I'm just going to let you discover it for yourself. If it works, great. If it doesn't, I don't care. I don't care either way because I'm not going to be trading any of that. So London, you're going to look at the previous day's range. And let's assume that you're looking for lower prices. You think that weekly candle is going to expand if yesterday's daily range is up close or down close. There's more advantage if the candlestick from yesterday is up close because you want to see a move that breaks below that yesterday's low. Once it does that, that lower 0.25% or lower third of that daily range, if you are in fact correct about your analysis and it's going to go lower based on the weekly chart, your sell setup is going to form in the lower quarter or lower third of the previous day's range. Now, by itself, that's not earth shattering, but I'm going to tell you something right now. If you chase price action and you always get burned, go back and look at your losing trades and you'll see that's exactly what you didn't see. So it has to refer back to a previous portion of the previous day's range. And this is not new. This is all in my core content. I teach this in core content. But because there's so much content and you breeze through them too quick, like Netflix and chill, you're binge watching. And it's so much information. You have to watch these videos multiple times because you're not gonna have an appreciation for what I'm talking about because you haven't encountered it yet in price. And then when you start looking at it conceptually and looking for it in old moves, then it's impactful. Then it has much more meaning to you. And then you'll learn more about using it and how it will groom you into a better analyst. You can't be a good trader without becoming first a good analyst. And so many of you just want to be a rock star trader and not know how to read markets. And it never works. That never works. That's why you get these flash in the pan, winners, but you can't hold on to them. You're like a gunslinger that just picked up a gun for the first time and you got lucky. You got lucky, and now when it comes time to do a duel with someone who has lived their life as a gunslinger, you get gunned down. And if you have the breath in you long enough to think about what you did, you'd be admitting, oh, I wasn't ready for this. So in London, you're looking for false breakouts. Okay. And you want to see, now this is where you write stuff down, folks. You want to see some measure of a 15-minute or 5-minute relative equal highs inside of the range that would be in the lower third or 1/4 of the previous day's range when you're bearish. Now, some of you are like, why don't you just do this on a video? Can you just show me? Can you just listen? Because I'm explaining it to you. This is how you learn how to do it. You go into your charts looking for it. And when you find it and you do examples of logging that and having dozens of them as examples, then it's more meaningful because you found them using these rules. Whereas if I just show you a chart, oh, okay, well, it doesn't mean anything to you. You didn't do any work to look for it. But when you see it and you study how it reacted in price after that, okay, we're anticipating that future reaction by price. We aren't reacting to price. We're anticipating price to do these specific things, which is what? If we're bearish in London, you want to look for a single high or a relatively equal highs inside of the previous day's lower 1/3 or 1/4 part of the daily range of yesterday, whatever the yesterday is. If it's a Monday, it's Friday's daily range. Otherwise, it's whatever the previous trading day is. That's pretty simple rules, right, folks? So in between 2 o'clock and 4 o'clock, we would anticipate a rally above those relative equal highs on a 5 or 15-minute chart, whichever one's easier for you to see. Regardless, you'll see it. If you want to use a 15-minute chart as a bellwether, I use that as mine. But you can look at it on a 5-minute basis. And as it rallies above that, what's going to be resting above those relative equal highs or single high? Buy stops. And the characteristic for the London session is to run up and entice traders to chase it going long. When in fact, it's a function of running into buy-side liquidity for smart money to absorb those buy stops and be counterparty as they flood the market with buy orders. Shorts are entered by smart money there because it's a run on liquidity. It's engineered to provide a entry mechanism for smart money to go short. It takes a lot of confidence to take that type of trade because usually in London, the Judas swings are very violent and they're quick. And it feels like it's going to go up 100 pips. It's going to go up, 80 handles on the S&P. Look at this thing move, man. Wow, it's going up 12 handles. Look how fast it's moved. This thing's going to keep on going. If you feel that way, you're reacting to price. When we're looking for that to be a run real quick to get to those stops so that stops can't be pulled. And once that happens and the orders are not pulled by the traders that have those orders resting there, we anticipate price rejecting there and going lower. Now, if you can't take that type of trade or entry, In the beginning, you won't. Let's just be fair. I say this all the time. Buying sell stops and selling short buy stops is one of the hardest things to do as a trader, because at the time when it happens, it's fast, it's furious, and it's scary. And you have to know what you're looking for, which is why you have to anticipate and predict the future. You have to. Profitable trading is predicting the future, folks. I don't know why you want to argue with that, but that's what it is. Reacting to price. Okay, you reacted to what it did and you entered into a trade. Now what? You just let whatever the wind carry you in the current without a rudder. You just, whatever happens, happens, man. Stuff's all random. If that's how trading really is, the hell with that. I'm never going to do it. I would never do that. Anybody in their right mind that would go into a venture like that, risking money, saying, well, you just got to see what happens. You know what that did for you when you start your demo trades, right? You get out there, let me just push the button on board. Let me see if I can make $5,000 in 10 minutes. And you lose. So you know that mentality, what it does for you. And it's not going to change with real money. Let me see what happens if I push the trade on. Boop, there it is. I got funded. I got through the portion of where we pass it. Now let me see if I can just make one of those real quick 5-figure withdrawals, because if I get one of them, that'll be enough to carry me through, even knowing that I don't know how to trade. And you wrestle with all that stuff because you're trying to do stuff that you're not prepared to do. You don't know how to anticipate. You're reacting, but you call it anticipation. You may share it with the community and me that you found a trade, but you're probably not being honest about what you felt the entire time you did it. It was just that one that panned out for you. So I'm not trying to encourage that type of thing in our community or in any of my students. You need to be 100% honest. And if you're struggling, find out what you're struggling on. But having a time-based approach helps you identify where your problem areas are. If you're not trying to trade at a very specific time of the day, how are you going to be able to measure your progress? How could I fix your issues for you if I was to sit down with you? I'm not making this invitation for you folks. I'm just saying, if you were granted the opportunity to sit down with me one-on-one, side by side, right next to each other, and say, okay, I just here's my problem here. I'm doing this. I took a trade in London, and this, that, and other thing, and then I saw this trade in New York, and I was doing this and doing that, and then I made some money there, and I was like, I want to go into the afternoon session. I'm going to trade the last hour in S&P, and then I lost everything. What am I doing wrong? Number one, you're overtrading. 2, you're not being a specialist. You have to be a specialist in terms of what market you're going to trade and what time of day you're going to trade. See, in your mind, you're thinking, wow, I can trade the London session. I can trade the New York Open session. I can trade the lunch hour when they run on stops. And then I could do the PM session. And I got the 2 silver bullets in the AM session, the PM session. Good grief, I can do this. And all of a sudden you're top of the leaderboard of FTMO, and you're winning the Robbins Cup, and you're blowing everybody else away on social media. And I get it. I know that's what everybody wants to do. But you can't do that. You're learning all of this at your own pace. And some of you, if not all of you, are not providing the permission that you yourself require of yourself to take whatever time is necessary for you to learn how to do this. Books, authors, teachers, mentors, courses, products, none of that is going to remove the impact that you yourself bring to this. The learning curve is going to be whatever it is for you, however long it is, because of who you are and what you wrestle with. And pretending that you don't have any of these problems that I talk about and other traders may refer to is nonsense, because there is no perfect student of the market that came in with no baggage or no mental barriers. Everybody has their own things. And some of them may not be a point of which where you overcome them. And it might not be feasible for you to do this. And then you would have to submit yourself to someone that does it really well, and you buy their signals or setups or their product. And in that case, I don't think that's wrong. I don't, if someone can prove that they have something that works, or they have a signal service that does well, and you can't do it yourself, I don't think there's any shame in that at all. There's no shame in that, because it's difficult, folks. You're the deciding factor in whether you're going to succeed or not. It's not the thing that you're using. It's you. It's you and what you are willing to do and what you're not willing to do. So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish, or a single high that is inside of the previous day's range. Now, I know there's no chart here, but I want you to think about it conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up, ICT? Wait. Look, you just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning, on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble, because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say? The best shorts will occur in the lower 50% of the previous day's range. Where do they form? Above old highs, inside of that range. Where you look for it, just like the algorithm will look for it, it's going to look into 15-minute high or highs, or 5-minute high or highs inside that range. So if you're in a 5 or 15-minute chart, it can't hide from you. It's right there. And you're going to anticipate the market running up there. And when it does, you paper trade it. You tape read it. You do not live trade it. You have to condition yourself to do this. And it takes weeks and months to do it. Not, a couple weeks I've been doing it. I don't know what I'm doing. No, you don't. No, you don't. You do not. It takes time to desensitize yourself to the fear that London can create, because it's very, very volatile. It can run up there and rip right lower. And really, if you know what you're doing, you can miss it or second guess it and totally do harm to yourself. So in London, you're looking for turtle soup scenarios, okay? And continuation on the basis of the higher time frame order flow. High a day, low a day is what's formed in the London session. Most of the time. Not all the time, most of the time. In New York session, this is going to be for Forex traders, the New York Open Kill Zone, which is 7 o'clock to 10 o'clock, New York local time. If you are an index trader, you can use that same time window as well. You use that time window before the opening at 9:30, like between, like, say, 7 o'clock in the morning, New York local time, to 8:30. You can trade that time window when there is a really big high impact news driver for that day. For instance, like FOMC. Okay. Say FOMC, or let's say, well, let's stick to that. FOMC is probably like the best case explanation for why you would want to trade before the 8:30 hour. Because generally what will happen is you'll get these really nice little price runs that are, and I've executed and showed you this throughout the year, and last year I was doing it too. And usually it's the time or examples where you see people saying, but didn't you say we have to wait for this and we have to wait for 10 o'clock? Folks, I'm giving you different models. That way you are allowing yourself to pick up on what you want to do. I can trade all of them, but I can't make you be able to trade all of them. I mean, over time you can if you put the time into it, but you have to find your own special time of the day in the asset class that you trade. And that's what I'm covering here. I'm helping you refine your level of focus so you can pinpoint what your model is going to operate in terms of time. So that way you're not doing more than that's required. You're not diluting your attention, and you're also controlling fear of missing out. Because if you're operating in a business model or trading model that allows you to only operate in this 2 or 3 window time period of every individual day, you turn the charts off and you walk away and you exercise discipline. Over time, you won't care what the market has done over here or this time of day or who made this, who made that. You're trying to get better at this. You can't improve by worrying about how much other people, me or anyone else, is making or losing, or how often we get it right or wrong. You can't do anything to make yourself better by doing that. So why are you worrying about it? If you're pocket watching me or anyone else, or if you're entertaining other people that do that, you are wasting your time. You're wasting time to groom yourself into the analyst that's necessary for that profitable trader to work with, because the trader's not going to be doing anything except for what the analyst says is good to go. And you can't do all these trading sessions in the beginning. You can't. Now, you can study and backtest all of them. That's not trading. That's a good use of your time. But you can't go in as a new trader trying to do all these things simply because you've heard about it or have talked about it. So therefore, you're going to go in there and you're going to figure it out. You don't figure it out that way. You study, you backtest, and you figure out where it fits for your life. That's the only figuring out you're doing. Does your life allow for you to trade in the London hours? Most people can't. If you can find time to get in there and trade in the pre-market hours before 9:30 and look for a setup between 7 o'clock and 8:30. Okay, there you go. You can find a setup that will probably yield you an opportunity, and then you're done. Where everybody else is waiting for the 9:30 opening in equities, opening bell in New York, to find their trade. Or if they trade the silver bullet model, they have to wait till 10 o'clock. And it's just funny when I see people, I'm taking trades and I'm doing something before 10 o'clock. They're like, wait a minute, didn't you say we have to wait? Who did I say had to wait? You. I didn't say we. I said you wait until 10 o'clock. I'm not saying we wait till 10 o'clock. I said you. I'm tweeting you wait till 10 o'clock. That's not me saying I'm not going to do anything else or anything in addition to, because I have a varying spectrum of experience in terms of students. Like, I have long-term students that have been here. I have charter members that are in my mentorship. I have students that have been with me longer before I did mentorship and never joined my mentorship. And their level of experience with me is much more vast than yours. And then I have the neophyte that just come to me today in this discussion today. First time they never heard me before, and they're listening to it. It probably doesn't make much sense to them, but their experience with me is brand new. So when I counsel you to do specific things or not to do certain things, that doesn't mean I'm limited to that. But to keep the growth of the entire community going, not just being a one-trick pony, which you can clearly see I have a whole lot of ponies in my fold. I got all kinds of models, okay? And my models work because of the element I'm teaching here, time. I'm looking for setups in the New York session. The characteristic for New York is a continuation of what? Whatever London did. When does that not occur? If the range expansion that occurred in London and then continues into New York and it trades to a higher time frame PD array, something that I would have been targeting anyway, which was the basis for the draw on the bias for the weekly chart and or daily chart. So in other words, if it gets in my higher time frame target, then what shifts in my analysis? Market reversal profile. Otherwise, I'm looking for New York session to continue in the direction of whatever that higher time frame draw is on the weekly and or daily chart. And I'm going to submit to that. And I'm going to look for the things that I teach you that the algorithm will show in price delivery, inefficiencies, runs on stops, the whole business. I'm looking for those factors to come in agreement with that. And if it doesn't materialize, or if it's wishy-washy, it could be done and explained both directions. That's low probability. It's not a trading environment I'm going to trade in. And then I watch, or I'll tell you, this is what we're looking at. We're watching it. So it gives you experience to see what it's like when it's not optimal, but still putting chart time in. You need to have that. And I have the other students that are coming here because their attention span is the size of a gnat and they want everything right now. It's already 3 weeks late. You just met me and you want to get right to the point of, hey, take a trade, or you don't know what you're talking about. Or you don't know what you're talking about because you're doing this and you're doing that and you're not entertaining me. This is not how I want to be taught. Then go somewhere else. I promise you, there's a lot of people out there that's going to teach you wonderful things to get into the marketplace. The results are not going to be what you would get in comparison here. You're not going to be in control of yourself. You're going to be constantly looking for a new high, not in equity, but in dopamine. And that's what social media traders and influencers present to you and provide you. I'm not trying to do that. Now, when the market performs a specific way, then obviously I'll put a meme out there, a little funny little, tweet of some kind to anchor it emotionally to you, not to make it look like we're celebrating, ego or anything like that. It's to make you feel like this was worth you watching it. And if it causes you to smile or laugh or, think to yourself like, oh, no, I see these a ham, it anchored it. And that's all I'm aiming for because it's meaningful because you didn't take a trade. So I have to give you that cookie, that yellow belt, from a white belt to a yellow belt. That's that little progression for you as a student because you didn't take anything out of it money-wise. You didn't lose any money. You didn't make any money, but I have to anchor it to something that you can recall or inspire you to journal it. Because until it makes its way into your journal, it's wasted time and attention. And I'm going to say that again. If you're watching or listening or look at my tweets and you do not journal the things I'm calling your attention to, you are absolutely wasting your time. You're not wasting my time. I know this stuff, but you're wasting your time. And that growth, that learning curve,